In this video, I will reveal everything you need to know about how to trade using trend lines and how to actually draw them properly. And second, how you can utilize trend lines to find high probability trade setups. How to identify the correct trend line. Trend lines are a popular technical analysis tool. They are the best indicator for trading. In this video, we will explore how to identify the correct trend lines and what devices are valuable for traders. There are many different types of trend lines. Some traders use them to predict the future price of an asset, while others use them to identify when a trend is going to reverse. The benefits of swing trading with trend lines. Swing trading is really a strategy that can be used to generate profits in the long term. It is a type of buy and hold strategy that is often utilized by traders who are searching for a more stable income. In swing trading, traders will buy an asset when it reaches the low of its trend lines and sell it when it reaches the high of its trend lines. They will then just wait for another opportunity to trade again. So without further ado, setup number 1. Break and retest. The break and retest strategy is quite a common strategy used by many different traders. The idea is that once you identified an active trend line, you wait for the price to break out of it. Sometimes the purchase price will just run away and the price won't look back. However, if the price trades back into the trend line, the retest can often be traded as a high probability setup. The timing can be carried out on a lower time frame or directly on the same time frame where you identified the trend line. The trend line acts as both the entry trigger and also helps to place stops. The stop loss is generally positioned on the other side of the trend line, and the trend line acts as a protection level between the entry price and the quit loss. The more touch points a trend line has, the better it is suited for the break and retest strategy. In the example below, the trend line has at least 3/4 valid touch points. During the breakout, there was plenty of volatility in the market, and the price hovered around the trend line for quite a while. The level of aggressiveness of the trader determines how early the entry will be taken. An aggressive and more risk-seeking trader could get right into a trade as soon as the price touches the trend line. A more conservative industry R would wait for the price to pull away from the trend line and exhibit signs of momentum into the trade direction. There is no right or wrong, and entry timing depends on the preferences of the trader. Setup number 2. Trendline Flag. Whereas break and retest scenarios can be considered reversal, trading, or early trend following, flags classify as regular or late trend following. With flags trading, you look for an established trend and then await a consolidation/pullback. If you can describe the pullback with a trend line, then it might be possible to trade such a flag once the price has broken the trend line and resumed trading into the trend direction. In the screenshot below, the price was first in a downtrend before the trend paused and established a flag defined by the trend line. Here, we can gain additional insights into the market participants. Whereas the initial downtrend was strong and the cost fell quickly during a short period of time, the bullish flag patterns only showed weak buying interest. Comparing the trend intensity can help with understanding how likely a trend line break might be. In this example, the downtrend was significantly stronger than the bullish flag pattern. This means a higher likelihood for a trend continuation lower. It is also possible to add a longer-term moving average to your charts when it comes to flag trading. The 50 MA helps identifying the long-term trend and will be type of trader would only search for flag patterns that signal a continuation into the trend direction. In the screenshot below, the moving average indicates a downtrend because the price was trading below the relocating average. The flag pattern indicates a temporary pause, and the break of the trend line confirmed the trend continuation. Setup number 3. Trendline bounce. Trendline bounces are also trend-following trading approaches. As opposed to the flag pattern, the trend line is not used to time trade entries, but to recognize scenarios where the trend line is acting as support or resistance. The price bounced off the trend line for the 3rd consecutive time, confirming the validity of the trend line. Then, traders would look for other technical patterns around the bounce to time trade entries. In this case, the purchase price has established a horizontal resistance level around the trendline bounce. The horizontal level then allows to time the trades after a breakout. In this strategy, the trader could either be extra conservative and place the stop loss all the way below the trend line, or work with an end loss below the resistance level. Again, there is no right or wrong. Everything depends on the risk appetite of the trader. I have talked about our stop-loss techniques before. Trendline bounces may also be used in a multi-time frame approach, and once a long-term trendline has been established, like in the screenshot below, a trader could then proceed to the lower time frames and time his trades using other technical concepts. In the following, we are going to take a look at the situation on the lower time frame for both trendline bounce scenarios that I marked with red arrows. On the left, we see the first bounce. The price action was rather messy here, so probably no trade entry would have taken place here. On the right, the price provided a head and shoulder structure, and with the help of another short-term trend line, the trader could have timed the trade. Using a multi-time frame approach can help some traders enter trades earlier and also find higher reward-risk ratio scenarios. However, you can furthermore trade the trendline bounce directly on the higher time frame if a favorable candlestick pattern exists. Trend lines can be great tools to possess in your toolbox as traders, plus some people find them to become more reliable than regular horizontal support or resistance. In our masterclass, we teach both approaches, and we help traders find what works best for them. You will get exposure to different trading strategies, observe how we trade them, and evaluate which works best for you. You don't need to sit watching your screen. Once you have identified a consolidation near the lower trend line, place a buy stop limit order a few cents above the consolidation high price. As we will discuss a little later on when we talk about risk and reward, a worse price than expected means a smaller reward. Danger. As you may have guessed, we're going to exit near the top of the channel. If we find yourself buying in the middle of the channel instead of near the bottom, most of our profit potential has disappeared. How and where to exit a trend channel trade? We have our entry nailed down. We also need to know where our exit will be. We determine where, or at least how, we will get out of a trade before we go on it. We need an exit plan for if the trade turns profitable, and we will require an exit plan for if the trade starts losing money. Trend channel strategy stop loss. A stop loss is how we control risk. For a long position, a stop reduction is in order to sell if the price reaches a specified price or below. For this strategy, place the stop loss several bars below the low of the consolidation if going long. Since the price must form a consolidation and our entry and prevent loss are based on that consolidation, we know both these levels before we have a trade. The first trade above is actually the fourth touch point in a larger channel earlier starting point. After that trade occurred, I adjusted the channel to the one above because it fit the recent swing lows a bit better. It is okay to update your channels if the original trend line is usually starting to look a little wonky, and there are at least 3 touch points to draw a new trend line extending off to the proper trend channel strategy profit target. We also need to establish where we will exit if the trade proceeds as planned and moves toward the top of the channel. The simple answer is at the top of the channel. But where along the very best of the channel? The upper trend line extends out to the right up, going up and indefinitely. The conservative estimate is to place the target at the price associated with the top of the channel when you place the trade. That means you look at what price the upper trend line intersects directly above your entry point. That's a good target to use when getting started with this method. As you become more comfortable with the strategy, you could measure how long prior advances took, or how far they ran to help set up a profit target. I just revealed to you multiple trendline trading strategies that you can immediately trade right now. And all I ask for in return is for you to invest 2 seconds of your time into liking the video and subscribe to the channel. It literally takes only 2 clicks, but it means so much to me. And you may also check out my other videos as well, so thank you guys for watching, and I'll see you in the next video.